This video is for educational purposes only and should not be considered financial advice. 3 ways to stop giving your gains back to the market. Many times when we are trading, we make certain preventable mistakes that cause us to lose money in the market. These mistakes are preventable because if we are aware of them, we will be able to recognize the urge to act in that way, and we will be able to stop that action. In this video, we'll be going over 3 ways where you can stop giving your gains back to the market. Number 1 is to stop overtrading. Number 2 is to respect the weekly market structure. Number 3 is to stop revenge trading. Stop overtrading. Wanting to catch every session's silver bullet trade. When we are focused on a goal, sometimes we become overzealous and try to do too much. You do not have to catch every silver bullet session to reach your trading goal. In fact, in trading, less is more. If you can catch a nice move that you planned for days, you can reach your goal in a short amount of time. The phrase, measure twice, cut once, comes to mind. Take your time measuring your trades and then enter with precision. You also have to factor in fatigue. Fatigue is a factor in trading, and when you overtrade, you can miss key aspects of your strategy and make some important mistakes. Whether it be in your trade execution, pressing the sell button when you meant to press the buy button, entering a lot size that was too large, or putting your stop loss in the wrong place. You will be better served if you are rested and fresh to the charts with your full attention. The market may have other plans. They may be holding one pair and moving another. Sometimes the market has its own plans, and they may be holding one asset in lieu of another. This is what ICT calls SMT, or smart money technique, divergence. For instance, the NASDAQ 100, which responds to the move in the dollar, could be going down as the dollar is going down, which does not make any sense. At the same time, the S&P 500, that also correlates with the dollar, is going up. If you placed your trade on the NASDAQ 100, you will be very frustrated because you thought it should go up. Now also, do not go and enter a trade on the S&P 500 after you just lost your trade on the NASDAQ, because the market may turn right around and go in the other direction. If you missed a move, let it go and plan for another one. The market may be waiting for news to make the big move on all pairs. Sometimes the market is just consolidating as it is waiting for a news event. If you are trying to trade these times, you will most likely lose a lot of money. The market will give signals for both directions and confuse and confound traders while it waits for its real move after the news event. Always remember, if you can see both sides of the trade panning out, you don't have an advantage. Number 2, respect the weekly market structure. The market moves mostly on Monday, Tuesday, and Friday. If you are trading on Wednesday and Thursday, especially during the New York session, then you may be giving back a lot of gains. Wednesday is typically the take money from traders day. Traders normally are trying to catch large moves, and Wednesday is typically a consolidation day, ranging from side to side. The same goes for Thursday. But there are times when price moves on Thursday, but this usually occurs in the afternoon. Sometimes price may move on Wednesday. If it does, it's usually in the afternoon session. If you made money on Wednesday, then do not trade on Thursday. Thursday will be the consolidation day. Having said this, price will do what it wants, so take these recommendations as tendencies and not written in stone. If you want more information on the weekly market structure, ICT has a bunch of videos talking about how the market moves in an AMD pattern, which is accumulation, manipulation, and distribution. The accumulation happens during Monday and Tuesday. Manipulation happens during Wednesday, and distribution happens during Thursday and or Friday. Number 3, stop revenge trading. If you lost your trade, then don't jump right back in to try to mitigate that loss. Wait for another setup or another session to trade. Unless you see a setup, do not jump to the opposite side of the trade just to try to make your money back. As we stated before, if you can see both sides of the trade panning out, you don't have an advantage. You need to plan your trades, and usually that takes time, looking at larger time frames and measuring the moves. To recap, stop over trading. When you have traded one of the silver bullet sessions and you've either had success or a loss, stop trading. Digest what happened that session. Create a logbook and log your trades to understand why you won or why you lost. Then get set up for the next session. That will give you enough time to prepare. Be careful of fatigue. If you take too many trades, you'll eventually get tired, especially at staring at the screen, and you might miss certain moves or make certain mistakes. The market may have other plans. They may be holding one pair for another. The market may also be waiting for news to move the pairs. Also, respect the weekly market structure. Don't trade during the middle of the week unless you see a perfect setup. That's usually the manipulation time. Also, stop revenge trading. If you have a loss, review your loss and understand why it went against you. Then get set up for another trade and be on the lookout for that same setup. We hope you gave you some things to consider when you are trading. As we all know, the psychological side of trading is the most difficult aspect to overcome. This is a lifelong process and requires retraining your mind to focus and respond in ways that will benefit you. If you found this video helpful, please like and subscribe for more videos like these. Thank you for watching.